Top 5 Beginners Investing Mistakes. Welcome to our channel today. We bring you the top 5 beginners investing mistakes. We're all taught as children not to do certain things and to avoid doing certain things, such as lying and wasting electricity by keeping the refrigerator open. When we reach adolescence, we turn to our parents for advice, and they once again instruct us about the things that we should not do and the things that we should avoid. We may not only avoid the same mistakes and have a smoother journey by learning from the mistakes of others who have acquired experience, but we can also have a tiny droplet of their wisdom that we can use to achieve beautiful things in our own lives. With this in mind, we've produced a list of the most typical stock market investing blunders that novices make that you can now avoid. Many people will advise you on how to invest and what to do in the stock market. However, only a few seasoned investors will advise you on what to avoid in the stock market. So in this essay, we'll go over some of the common investing blunders that any new investor should avoid. Many people lost their jobs as a result of the COVID-19 outbreak. Many students graduated from colleges unable to find work. Many business people take a break from their work and sit at home. Everyone now is looking for alternative work and jobs in these circumstances. Many individuals believe that trading and investing in the stock market is simple, and that many people make significant gains. They might hear of people making millions of dollars in a single day. Making investment mistakes that result in a complete loss of capital is the stuff of nightmares. Investing is made to appear as hazardous as betting everything on red at the casino in movies and novels. However, knowing a few golden guidelines will help you avoid some of the most typical investor blunders. Here are the unraveled secrets. Before we continue, please hit the subscribe button and click the bell icon to get more videos. Number 5 is not repaying debt and building emergency savings first. The 50-30-20 rule states that you should spend no more than 50% of your income on necessities like shelter and food, 30% on pleasurable things like entertainment and clothes, and the remaining 20% on savings and investing. This 20% should be allocated towards these two financial goals rather than investing until you are short-term debt-free or have an emergency savings fund. Long-term debt such as mortgages and college loans can be paid off as you invest, but short-term debt such as shop cards, credit cards, and personal loans should be paid off first. These have higher interest rates, so if you don't pay them off, you'll end up spending more than you'll make in investment returns. Find out which loan has the highest interest rate and pay it off first if you have more than one to pay off. After then, move on to the next highest interest rate and so on. It's also crucial to have some funds set aside that you can access immediately if necessary. According to a recent survey, 34% of Americans have no emergency fund, leaving them without any financial safety net in the event of illness or job loss. Experts recommend having 3 to 6 months worth of living expenses on hand. This means you'll have time to recover if you get sick or lose your primary source of income without having to worry about how you'll feed your family. Number 4 is investing all your money. There's no way around it. The value of your investments might go up as well as down, which means there's always a possibility of losing money. With so much volatility, it's not a good idea to invest all of your money. One of the essential investing guidelines is to never invest money that you can't afford to lose. This could include your rent payment for the next month, a carefully saved housing deposit, or the money you'll need to go on vacation next month. Make a primary financial calendar for your future, highlighting the significant purchases or spending sprees you'll likely make, such as housing, schooling, or your children's schooling, and finally retirement. This should give you an idea of how much money you have and when you'll need it. Any financial goal that is more than 5 years in the future is worthwhile to invest in. The longer you have until you need the money, the riskier you can be with the investment because you have more time to recover from any financial setback. Number 3 is not diversifying your portfolio. While it may be tempting to go all in on the hottest stocks, such as Zoom or Tesla, doing so puts your money at risk. If something goes wrong, such firms and their stock prices plummet. Instead, it would help if you strive for a well-rounded portfolio. Portfolio diversification means not placing all your financial eggs in one basket. There are 2 approaches you may use to do this. The first is the assets that you choose to invest in. Stocks, bonds, funds, ETFs, gold, and cash are examples of asset classes. It's a good idea to split your money between investments that will yield high returns but are riskier, such as stocks, and investments that will yield low returns but are more reliable, such as bonds. Different asset classes respond differently during times of financial instability. Thus, they gain from the diversity while the financial markets are performing as predicted. During a recession, for example, the price of stocks tend to fall while the price of gold rises. The goal of diversifying your investment is to counterbalance any losses in one sector with gains in another. The 5-25 guideline suggests investing in 5 distinct asset classes and never more than 25% of your portfolio in any one of them. You can then further diversify your portfolio by investing in a variety of stocks that you have handpicked. You will be safeguarded against significant losses caused by industry or country-specific financial shock if you choose firms from a variety of industries, sizes, and locations. Number 2 is not doing enough research. You must do your homework if you intend to choose your stocks to invest in. It's crucial to understand the company's history, how they've performed in the past, and how they'll perform in the future, and how they compare to their competitors. The first step is to determine their ticker symbol, which will list them on a stock exchange. After that, a short internet search will give you an idea of where the company's stock is headed. Apple's stock price has climbed over the last year and is currently trading at $113.85 per share at the time of this writing. If all this sounds like a lot of homework, or you're unsure when doing enough research becomes doing too much research, you might want to seek expert help. A financial advisor or full-service brokerage will have the knowledge and experience to advise you on the best investments to make. You can also invest in mutual funds where your money will be pooled with other investors and assets will be purchased on your behalf. In both circumstances, it's critical to have a thorough understanding of the fees involved. Essentially, the fees must result in a more significant reward increase than the money you paid for it. If your mutual fund charges a 1.5% fee, your investment must increase at least 1.5% to justify that fee. Number 1 is buying and selling based on emotion. It's all too easy to get caught up in the news, succumb to herd behavior, and do what everyone else is doing. This usually occurs during financial crises, when a growing sense of fear in the investment world develops to the point that everyone is anxiously seeking to sell their stocks before losing all value. On the other hand, it's easy to get caught up in the firm's enthusiasm that everyone is talking about and buy stocks while the price is rising or even peaking. The fact that the market fluctuates is a universal truth. Doing nothing is frequently the wisest course of action, and while it may appear to be the wrong investment decision, it is the smart one. Markets do fall, but they have always risen back afterwards, so all you have to do is keep your wits about you and your investments. However, there may be occasions when you desire to sell your assets or exit a particular business entirely. Many people are avoiding fossil fuels. Many investors are selling their fossil fuel holdings since they are unlikely ever to perform as well as they once did due to the shift to greener energy sources. Examine your investments frequently to see if they are still performing for you. Are you still willing to support that business? Do you believe the industry will increase, or do you think that there will be a global decline? Please return to the investor pages of the firms you own stock and see what they believe the next 12 months will bring for them. When you invest in individual stocks, you must keep track of their performance regularly. Alternatively, you can invest in mutual funds or ETFs and have the fund manager make those decisions for you. That's it for the top 5 beginners investing mistakes. If you liked our video, hit the like button and subscribe to our channel for more videos. Thank you for watching and see you next time. Comment down below your favorite part from the video.